Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, June 7th, 2021, and I'm pre-recording this Trading Places Live for Tuesday, June 8th. Futures currently are trekking a little bit higher. NASDAQ doing a little bit better than the others, but NASDAQ futures currently up about 60 points. The S&P 500 up 9, which would take it to a new high, or at least above the old closing record high on the S&P. So we'll see whether or not that holds overnight. Dow Jones futures up about 34 points, still probably about 1% away from that 35,000 level. We're going to get into a lot of that action in just a minute, but I want to first go through today's agenda with you. We'll start off with that daily market recap, take a look at what happened on Monday, then get into talking technically. RRG charts. I've looked at some of these recently. I'm going to pull up some additional charts I think you'll find interesting. Then earnings spotlight. Not a whole lot of earnings coming out this week, but we do have a few, so we'll go over some of those, and then we'll wrap up today's show with the 3 you must see. Before we get into any of that, I will take you over to earningsbeats.com, where you will see we are running our spring special. It extends through June 15th. And so if you click on that on our website, it'll bring you back here, show you exactly what you get. The big thing is, from a monthly membership standpoint, where you'll pay $147 a month, the spring special includes 14 months. So it's a regular annual deal plus 2 additional bonus months. And all of that for 14 months only is $997. So that's more than 52% off of what would cost you $2,058 at that regular monthly clip. So this special does end on Tuesday, June 15th. I'd love to have you. If you come over and sign up for a trial, you'll get not only your 30-day trial, but then 14 months on top of that. But you would have to sign up for the annual deal by June 15th. That's why I think it's pretty important to check out the trial as soon as possible and see if this is something that would appeal to you. Going back to the home page, down at the bottom on the left-hand side, always like to make sure everyone's aware we do have a free newsletter, the EB Digest. That's published 3 times a week, Mondays, Wednesdays, and Fridays. Before the market opens, all you need to do is type in your name, email address, hit that subscribe button, and we will get things started for you. There is no credit card required, and you can unsubscribe at any time. Normally, the newsletters focus on relative strength, earnings, sometimes seasonality, occasionally RRG charts, a number of different things that are mostly educational in nature, but also provide solid trading opportunities from time to time. So if you go to earningsbeats.com, you can go scroll down to the lower left and you'll see these boxes for name and email address, and you can subscribe. If you want to try us out for a period of time, we do have a no-cost trial. So you'll get 30 days of everything we have to offer, and it'll cost you $7 up front, but we'll refund you the $7 within about a week. So it literally is a no-cost 30-day trial. And again, if you do like what you see, you will have up to June 15th to extend using our spring special. All right, let's move on to the daily market recap. And on Monday, Dow Jones Industrial Average down 126 points, S&P down 3, although we did come back late in the day, which was nice. NASDAQ showing relative strength, and you can see breaking to about a 5-week high, gaining 67 points, or about 0.5%. Mid-caps looking to me like off of an uptrend, maybe in a symmetrical triangle pattern. See the lower highs and the higher lows. So it seems to be that we're squeezing between about 2,700 and 2,750. So we'll see which way breaks first there. Small caps broke out again, though, today. Another new all-time high. So really good action on the small caps, closing at 1,397, or up about 1% on the day Monday. Real estate continues to be on fire. So the XLRE pushing higher, up another almost 1% on Monday. That was your best performer. Communication services broke to an all-time high. So we did get a nice continuation move on communication services after a strong Friday. Healthcare bouncing off of its 50-day moving average. I talked about this one recently. I thought that 50-day might provide us a pretty good opportunity for entry without a whole lot of risk, because if it did go close below the 50-day, you get out pretty easily without a whole lot of damage. So healthcare still looking pretty good there. Materials not so good today. We did close at 86.84, which was just 1 penny above the 20-day EMA. So this is a group really to watch closely as we get closer to some key inflation data coming out. You would expect materials to lead, but materials have been struggling over the last month. Part of that is sideways consolidation. When we consolidate, we tend to underperform. So that could be part of the reason. But with this inflation data coming out, if materials don't break out, I'd be a little careful with the group. Industrials also weak on Monday, lost about 0.7%. You can see equal highs, rising lows. Could be looking at an ascending triangle here with a breakout, hopefully in time. All right, 10-year Treasury yield didn't really do a whole lot. We gapped up a little bit at the open and then just kind of were flat, maybe down a little bit from that open, but still up for the day, about 1 basis point to 1.57%. We just simply consolidate here. We're continuing to consolidate in that 150 to 175 range. If inflation truly is a problem, if the market believes inflation's a problem, we should see interest rates moving higher. Haven't really seen that yet. Most folks would be wanting to bail out of the 10-year Treasury, any of the Treasuries, to be honest, with inflation, potential inflation looming. So the fact that we're not moving up here is telling me the market really is paying much more attention to economic strength and really not paying a whole lot of attention to what's going on with inflation. Economic reports, not a whole lot out this week. Thursday, we will get that May CPI report, and along with that, of course, May core CPI. Initial jobless claims will be out on Thursday, and then it's next Tuesday when we get the PPI data, and then, of course, a Fed meeting Tuesday and Wednesday of next week. So there is a lot going on, but we'll see whether or not we make a break out of this trading range on the 10-year Treasury yield. All right, talking technically, periodically, when we start talking about inflation, it's kind of important to understand what's going on with the dollar and where the dollar might head. So this is a chart that I use a lot to kind of help me forecast the dollar. And it's really just looking at what is going on in the US versus Germany in terms of Treasury yields, because Treasury yields should rise when economic activity is expected to increase. And so if we look at what's going on in the US versus Germany, if our yields are rising faster than Germany's, it should be an indication that our economy is strengthening. And if that's the case, we should see a strengthening dollar. Well, if you look over time, this is simply the top part of this chart is simply the difference between the US Treasury yield, 10-year Treasury yield, and the German 10-year Treasury yield. And for the most part, we've been rising since the late 2000s, 2008, 2009. And as a result, because we have been going mostly higher, the US dollar has been mostly going higher. And when you look down here at the correlation, you'll see that the correlation between the difference in yields in the US versus Germany tends to be pretty positively correlated with the direction of the dollar. We spend almost all of our time in positive territory, many times up near +1. And when you look down at the negative side, we rarely go below -0.5. So I think it's clearly there's a pretty tight positive correlation between what's going on in our Treasury yields in the US versus Germany's, and then what's going on with the dollar. Now, the shaded areas highlight divergences where we see the US dollar rising versus Germany. That's all these green shaded areas, while the dollar is declining. And what that does is it results in these inverse correlations or negative correlations. And in every case that we've seen over the last 13, 14 years, it's always been the dollar playing catch up. So if the dollar is going down while yields in the US are rising faster than Germany, the dollar comes roaring back. We saw that back in 2009 and into 2010. We also saw it 2013 to 2014, where yields were going up, dollar went down. And then at the end of 2014 into 2015, we saw the dollar come surging back. Same thing happened in 2018 when we went, had an inverse correlation. The red shaded area is the opposite. So in this case, we're showing the dollar going up while US yields were moving lower versus Germany. So what happened? The dollar came crashing back down. Well, what we're seeing right now is this treasury yield in the US still moving up versus Germany. It looks like it's just starting to turn back up again to strengthen. So yields in the US moving up faster. And as a result, we expect the dollar to go up. But what's happening? The dollar is going down. It's still down near uh, a multi-year low, really, and not too far from major support area at around 88 and a quarter to 88 and a half. And this is all taking place while yields in the US are moving higher. So I suspect we're going to see the dollar turn back to the upside later in 2021, second half of the year. If that happens, if the dollar moves up, then you have to realize that the relationship between the dollar and what the dollar does, you have to understand the relationship, what that does to energy on a relative basis to the S&P 500, and also what it does to materials relative to the S&P 500. When the dollar is moving down, energy outperforms, materials outperform. When the dollar is moving up and trending higher, that's when we tend to see energy underperform, materials underperform. Now, if you look back over the last year, you'll see that the dollar has been moving lower. As a result, energy's gotten its footing and materials have been moving higher on a relative basis. So that's one of the reasons why it's so important to follow this, because if I'm correct and the dollar does begin to strengthen again in the second half of 2021, we should see energy and materials roll back over and start downtrending on a relative basis. Now, energy, I think, might still have a little bit more room, and it's a whole different story. But I see a pretty bullish pattern that's just broken out on crude oil prices. And so I think energy may hold up a little bit better. And if you look, energy, even when the dollar was coming down, energy struggled for a while. So we may have a little bit more upside left in energy. I feel stronger about energy than I do materials at this point, even though materials have been stronger for a longer period of time. Uh, we'll see whether or not that continues. Materials, I think, watch that 2018 high, because I think that's what, we were in this downtrend, relative downtrend, and that was the last significant high before we had this pullback, and now we're rising. Can we get back through that level? I don't think we will. Just my opinion. All right, let's move on to small cap. So I want to go over these RRGs with you. So the first thing I wanted to do was just show you use the benchmark of the S&P 600 small cap index. That's the dollar SML. And then many of these small cap ETFs for each of the sectors, I've put on here to show, we can kind of walk through what's been taking place in the small cap area relative to the overall index. So I'm going to go back to where we were a year ago. And what we were looking at back then, energy had been horrible. And you can see it way over here on the left side. And on the scale right here, this is relative strength going across here. So you had 80, 100 is kind of par. So if you're below 100, you're going to be further and further to the left. Now the vertical scale is your momentum. And so when you're up above this, this center vertical line, then your momentum is picked up. But when you're left of the center vertical line here, that means that you've got some relative strength issues. So with PSCE back a year ago, it's telling us that we're still weak on a relative basis because we're left of this vertical line. But because we're so much above the horizontal line, it's telling us that momentum has been strong, or it's been strengthening. Now, I'm going to go ahead and just highlight the PSCE here. If you do that down here on the bottom part of the chart, then you can see what's going on in the rest, but it really highlights energy. And so if you take a look at what happened with energy throughout the last year, see how we kind of failed to move into leading, and we went all the way back to lagging. A lot of times when you're relatively weak, which means you're on the left side of this vertical line, you'll go into improving, but before you can go into leading, a lot of times that relative weakness kicks back in again, and you go back down to lagging. So you sometimes can get stuck over on this side. But once you make that move over into leading and really start heading into that northeasterly fashion on the chart, that's when you've got a very strong group. And Julius DeKempenaar, a good friend of mine, who also is the founder of the RRG charts, he likes to talk about the length of these tails. So for instance, the tail length is 5 weeks. So it just kind of gives you, it retraces your steps where you were over the last 5 weeks. And when you really start to see strength, you will see things pick up, and those tails will really start to get long as you move from improving through into leading. And so that's what I would be looking for anytime you're on the left side. Now you can see the tails accelerating to the downside there. That's not good. But that was back in October or early in November of 2020. But once that virus came out, look at it turn. So right here is November 9th. That was the day that the vaccine news came out. The very next week, look at what starts to happen here with energy. And look at the length right there. I mean, we're December 14th, but look at the length of this tail. That's telling you over 5 weeks, we have really picked up momentum to the upside. Look at all the others. Now, I know they're, we could go over here and, highlight some of these over here, but you can see the length of the tails. They're not really doing much relative to their benchmark. But that PSCE is absolutely, and as we keep dragging this across, so there's December 21st, the 28th. Now look, now we're going into that leading area. And again, look at the length of the tail. That's telling you the power that the energy group had. So now we're into February, and February 16, 22nd, March 1st. Look at it starting to curl back up again in northeast fashion. And now we're all the way over here past 115. That's a lot of relative strength. We are further over on the PSCE by far than any other small cap area. So it's just telling us how powerful the small cap energy space is. And then as you can see, we come back into weakening. Now, when we were over here in lagging and we went up to improving, remember we rolled over and went back into lagging? Well, watch the PSCE here. See how we're starting to curl back up here now? Now, this is June 7th. I mean, so this is current, but we were in weakening, but we're starting to turn back up again. So this is telling me that energy still remains pretty strong. We're still the furthest right on this chart. Even though we've been weakening in momentum, relative strength, we're still further over than any of the other small cap areas. So I think this is important because it's telling us that energy remains a dominant area in the market. So if you're a trader, I think it's still an area where you want to consider operating. I mean, you want to see mostly I stay with relative strength winners. So I'm going to stay mostly on the right-hand side of the chart. Now, I'm going to take this a step further because let's break down that PSCE. The PSCE is an ETF. So how about we take a look at the top holdings of this ETF and put those into a relative rotation graph. So here we go. Now, this is where a year ago, these were probably not the top 10 holdings, but you can still see where they have been and how they meandered. There's REGI, which is a renewable energy stock. The only one really doing well last year as we headed toward that vaccine news. You can see way out here to the right, everything else pretty close to the center line or even left of the center. So these other energy names really were not doing well at all. But there's November 9th. Now let's watch what happened from here. Look at SMCPE. These two right here were the two that really took off. They're the ones that are up at the highest, meaning the highest momentum. And now they're moving over to the furthest to the right side, meaning best relative strength. That's why as you move into this leading area in northeasterly fashion, that's telling you the stocks that are the strongest. Now, as we go through this period, you can see SM and CPE starting to curl over, but look how far we are to the right. Tremendous relative strength. And then we come back over here, and I'm looking for both of these to start to turn back to the upside. So we're losing a lot of that relative strength, but that's okay. That probably is telling me that the stocks are consolidating. Meanwhile, we've got RRC and SWN moving up and strengthening into the leading. So I thought what we would do is maybe take a look at these four charts and just kind of get an idea of what's going on here. All right, so let me pull up first let's take a look at the two that are strengthening. Let's look at RRC first. And we'll pull that up on a relative basis, and that's relative to its peers and to the S&P 500. But here you can see what's going on. I mean, on the price chart, I think it's pretty clear. We broke out a few weeks ago. We've been moving up now for about 6 weeks. So RRC clearly is broken out very strong. We pull up SWN, we should see something somewhat similar. Yeah, I mean, here it is again, 6 weeks. We've broken out above these prior highs, pulling back a little bit, but trending above the 20-day moving average. Now, when we go to pull up SM and CPE, we should see prior strength and now maybe consolidating. That's what, before I even look at a chart, that's what I would be thinking. Well, here was your prior strength for sure. Here's your consolidation, but this actually just broke out recently. So I wouldn't be surprised to see that RRG start to curl back up again. We were already beginning to see a little curl. I would say with this breakout, I would probably begin to look for even more movement to the upside. And then the other one's CPE, and same thing. Huge outperformance. Here's your consolidation. So this is where we struggle on the RRG and we start moving into that weakening quadrant. Well, we just broke out again here over the last week. So don't be surprised to see CPE begin to move up back into that leading quadrant again. So that just kind of shows you how things look on the RRG versus how they look on the price chart. All right, let's move on to earnings spotlight. And so the first stock we'll pull up is Marvell. MRVL. This is Marvell Technology. I'm seeing a high back in January, a low in March, and just consolidation since then. Going up above and below, above and below, above, and now testing. So far at least holding on to the rising moving averages. But prior to this, just looked like a trendless stock. Now at least it's starting to show characteristics of a trending stock to the upside. They reported earnings after the bell, 29 cents versus 27 cents. And the stock was up 4.25% after hours. So it does look like it's breaking back out to new recent highs. Going to have to try to negotiate that 51 area and then eventually 55 from that high back in January. So maybe we're starting to see a little bit of strengthening here in our MRVL, but the report was pretty good. Earnings were good, 29 cents versus 27. Now, then you got Coupa Software, COUP. The stock's been trending lower for quite some time. So you can see on a relative basis, look how poorly it is relative to software. They beat on their bottom line. Market was expecting a 19-cent loss. The stock posted a gains, posted income of 7 cents, 26-cent beat. Stock's down almost 9% after hours. Now, I don't know. We'll see whether or not this is the bottom, and I'm going to maybe stretch this chart out just a little bit longer. Let's go out a year and 6 months. And the reason I'm doing this, I want to see what the lows are. I mean, we've got some support here that we couldn't hold, had basically 3 lows, couldn't hold, went down, hit the 20, went back down. Looks like we're going to break down again at the open tomorrow. 8%, almost 9%. That would be close to about probably $21, $22 that we're looking to be down. So I'm going to say maybe 214, 215 is where we'll open, which is going to be down here. Do we hold it? Do we show a hollow candle to print a really significant bottom? That's what I would be watching for tomorrow. But yeah, not going to get off to a good start based on the after hours on Monday evening. MTN, this is Vail Resorts. Vail Resorts also beat barely, $6.71 versus $6.67. It was trading down after hours, but less than 1%. Really needs to negotiate 340. Until it does that, probably just more consolidation ahead. Health Equity, HQY, down about 5.5% after hours, even though they beat 38 cents versus 31. I would watch maybe to see if we do open below that 20-day moving average. Can we get back up and go above it? That's what I would be looking for on this stock. on Tuesday. Stitch Fix, big winner after they reported loss of 18 cents. Wall Street was expecting a loss of 27 cents. Stock's up 16% after hours. This has a history of just big gaps everywhere with earnings. So it's really hard to take a position in this stock and hold it into earnings unless you're going to maybe, I don't know, have a bottle of Pepto-Bismol next to your computer. But SFIX is getting a positive rebound or positive response and is up 16% after hours. Last one I'll go over here, REVG. This is Rev Group. After moving up, it's been sideways consolidating. Stock up 10% after hours. Looks like we might get a breakout above that prior high. I would watch to see if the stock opens above 2133. Actually 2134. If it opens above 2134, and that would take about a 9% move to the upside. And like I said, after hours, it's up about 10%. But 2134 is a number I'd watch. I think a break above that on the opening bell would be a bullish sign. All right. We do have some other reports coming out later this week. GameStop, GME, one of the big meme stocks. That is one you want to keep an eye on. GameStop, let me just pull the chart up for you. I mean, it's been moving back up near the highs that we saw in March, which were reaction highs. Seems like with its market cap, it's going to have to come up with a pretty big number. We'll see what transpires there. Campbell Soup, a more defensive consumer staple name, been going sideways for a long time. This is an 18-month chart. Seems to not matter. Here was the pandemic. Went down quickly and then rose right back up. And we've just been in this trading range, $43 to about $52 mostly. So we'll see what happens there. Thursday, Chewy and Fuel Cell will be out. Chewy downtrending recently. You can see on a relative basis been struggling. This is a stock that led during 2020 during the pandemic, and many of these stocks are coming back. So we'll see what kind of response we get on this stock, but it is trending at least short term above its 20-day moving average. And if it can continue to do that after its earnings, I think that would be bullish. All right, let's move on to the three you must see. Let's wrap this thing up. First stock up is NEO. Just want to point out here, this is a stock that was extremely hot back in 2020. We topped in January. We had been trending lower. Now it seems like we're trending back above the moving averages. Just closed at 43.68, which was the highest close we've seen since back in March. Really good action here over the past 4 weeks or so, 3 to 4 weeks. And it is breaking out. Like to see a little bit more volume coming in, but as long as we stay above that 20, I think NEO is looking pretty good. Next up, BYND. This is Beyond Meat. This is a stock I've talked about recently. It's on our short squeeze chart list, meaning there is a heavy short interest in the stock. A lot of folks betting against it. And when you get stocks that break out on heavy volume, it starts to put a squeeze on those who have unlimited risk as the stock keeps going higher and higher. We did break out again on Monday. I wouldn't be surprised to see the stock continuing to push higher. BYND looks good. And then the last one I wanted to mention, ILMN, nice breakout here, breaking above all of these tops after the big selling we saw back in March. The reaction highs all came up to about 420 to 430, unable really to sustain it. Looks like we're trending above the 20 now, and ILMN starting to strengthen with the PPO back above its center line, looking much better. All right, that's it for me. Appreciate everybody tuning in. Have a great Tuesday, everybody. And just keep watching. We got that inflation report, big one, the CPI coming out on Thursday. Have a great day, and I'll be back at Earnings Beats on Wednesday morning for your next Trading Places Live at 9 a.m. Eastern. Go to earningsbeats.com to check that out. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.